Sorry about that. Thanks, Lewis. I now have audio, so I've been talking to myself. Sorry about that. We're going to go live in 1 minute. Like I said, here's a chart on the market that happened today. So we have a little news about inflation, a little bit of news about the consumer price index that was released today for January. We're going to talk more about that in a minute. We'll get into it, and I'll bring in some questions and answers and find out what's of interest to you guys as well. But I'm going to cover quite a few things on taxes, investments, and fees, and some case studies, and relating to what's been talked about as far as where the markets may be going and how many rate cuts, if any, we're going to have in the short term. So with that, let's get started. So I'm going to back up this screen just a couple here. There we go. And again, my name is Mark Stoker. I'm your host tonight with On the Mark Money. The top 2024 lessons learned from 2023 that cost many people as much as 30% of their nest egg in retirement. And so what do I mean by that? Well, let's take a look. So first off, here's the CPI that came out today. The Consumer Price Index numbers came out for January. And like I asked in the front end, are you feeling the effects of inflation? Are you seeing anything change? And so like I said, when I go to the store, my prescriptions are certainly much higher. But where are you seeing the change? Put it in the chat box. Where are you seeing any changes in inflation that you can put your finger on? That is not just circumstantial. This is like you know effects that are actually causing you a change in your budget even. So I can tell you that my one thing I notice is obviously pharmaceutical. So that's for sure. So just put it in the chat. And if you're seeing inflation changes, give me a 1. If you're seeing no inflation changes in your world, give me a 0. So with that, let's take a look at what actually happened. So the consumer price index came out today, which was a little hotter than expected on inflation. So that caused a lot of the irrational exuberance, this run up on the markets the last 6 weeks to 8 weeks, 15% run straight up. We had a little reversal today. So the markets were all broadly across the board down 2% for the most part all day long until about the last 30 minutes. And then they came back a little bit. So I have a feeling this will probably be another fun day tomorrow. Don't know how far this will go, but we will find out. So let's talk more about that. So here a little bit about myself. I'm a fiduciary financial advisor. I've been doing this for 33 years. I've helped hundreds of pre-retirees and retirees, help them with their retirement planning, income planning, Social Security planning, and investment planning. And our goal is to help you as well. And I'll talk more about what we do and our big 3 things. We work with clients nationwide. I'm a registered investment advisor. Every registered investment advisor starts out as a stockbroker, if you want to call it that. I'm licensed in Series 7, 6, and 65 and 63. I have a general license in many states on insurance as well. We do insurance planning, investment planning, and planning. So we are a member of the Better Business Bureau as well as FINRA, National Ethics Association, and we are independent. And so we do work with active managers that are CFPs and CFAs, and one of those is Brookstone Capital Management. We'll talk more about them in a second. I use Charles Schwab as our client custodian. They are the largest public custodian. Fidelity is the one that's private that's the largest, but Schwab's the largest public custodian with $8.8 trillion. So we just work with clients and we manage their portfolios. We don't have any access to their funds, so it's all arm's length. You'll see my website there on the Mark Money as well on the bottom, and we'll talk more about that in a second. So we have 3 big goals we specialize in for our clients. Number 1, we try to reduce your fees by 40%, and that is tens of thousands of dollars back to you. And we'll talk about that in some case studies before we end tonight. Number 2, we have a goal to grow and protect your retirement income throughout your lifetime. So big number 1 is thousands of dollars off the top on fees. Number 2, grow and protect your retirement income throughout your lifetime. What does that look like? Well, it could be I want to have $50,000 $60,000, $70,000 for the rest of my life for the next 30 years in retirement, let's say. Or maybe you want $200,000. It depends on the situation. Then on third goal we want to do is we want to find a way to do all those things, plus also double or triple your portfolio at the right risk size, and then maybe elevate your lifestyle as well. So we have those 3 big goals along with your goals. So with that, you say, hey, I want to find out more about On the Mark Money. You can look up our firms. We have 3 companies: Stoker Financial, investment side; Stoker Insurance is the insurance side; and On the Mark Money is our planning company. Stoker Financial, you can plug into BrokerCheck. Go to brokercheck.com and you can plug in Stoker Financial Inc. and it'll take you right to our FINRA website page right there. And our CRD is 119796. That'll take you to that. And then you can also look us up on Better Business Bureau. We have an A+ on no complaints as well. We're also on LinkedIn. You can find me pretty easy there. And then also National Ethics Association is another thing that we are members of. So you'll see on the screen there a picture of my mother and my daughter on the left-hand side, and then a picture of me at a younger age with my grandmother in the middle and my mother and my daughter. My grandmother's 100th birthday. So that's a long distance there. So 100 years. She actually went to 103. Reason I bring this up, my mother. So the personal story here. Why do I do what I do? Well, if you go on my website, you'll find the same video that I talk about this. But my mother worked 50 years in her career. She was an HR manager, and her last position was at Ford Motor Credit. And wouldn't you know what Ford did right before she turned 70? You can imagine, right? So she was laid off 2 months before she hit a pretty good chunk in pension increase. And so they did that dirty deed. So she had to kind of adjust her expectations in her retirement planning. And so that's kind of why I do what I do. I help people navigate the pitfalls of what can happen in retirement. In fact, my daughter right there on the left-hand side, she was just laid off 2.5 months ago. And so even though she might have had a little foresight that it was coming, but it's still one of those challenges, right? And so we know people have challenges that are coming in from different journeys. We know maybe you're in retirement, maybe you're in pre-retirement, maybe you're already have been retired for a long time, but maybe you're early into this game and you haven't thought about retirement as a ways off. So all these things are relative to you, and we talk and work with clients on all levels on the journey. So with that, when you do sit down with us on a Zoom call on the first meeting, it's no obligation. It's a discovery call. But what we do is we walk through a process, and we have the same process with everybody that we talk to. So our process is pretty simple. It's about a 30-minute call, and we walk through the thing that we call a riskalyze or a nitrogen. I'll talk about that in a minute. The second thing that we do, once we go through this process on our first meeting, and you feel out, hey, how does that look? How does that feel? Our second meeting is, again, if you want us to do an analysis, normally $497. We do it for $1 as a fiduciary. We want to make you a client first. We have a very low bar to make you a client. So $1 legit. I will charge $1, but we want to have that available to everybody. So $1 to do our second meeting, which is an analysis meeting. So, but what we find out is that we want to find a way, again, to reduce your fees by 40%, grow and protect your retirement income throughout your lifetime, whenever you want to engage that, and then also double or triple your portfolio at the right risk size to elevate your goals and your lifestyle. And so you might say, hey, Mark, what are your fees? What are your fees? And so if you go to onthemarkmoney.com and you go on the very bottom of the page there, you'll find sitemap in our bottom footer. Click on that. It'll take you right to our fee schedule, and you'll see that we have very aggressive fees that are very competitive. We do that for lots of reasons. I want to sow a seed forward, and so that's why I have those set at the numbers that I do. And we'll talk more about that and how that can impact you on your retirement journey, and we'll get to it in the case study. So with that, one more thing, like I said, we're going to cover case studies and how we do things. We do things with a balanced approach. We do have managed growth portfolios. We have protected growth and income portfolios, and we have protected income approaches on all of our portfolios. And it depends on the client situation, but we look at a balanced approach at every case. And so if we have a blend of all the things, we want to make sure that your income lasts a 30-year window, not a 10-year window. And so we want to make sure it makes sense, it's flexible, it fits your lifestyle, and you're not locked into something that you don't want to be locked into, right? And so it's one of those things that we actively manage as well. So with that, one of the things that we do, like, for example, I mentioned Brookstone Capital Management as one of our investment advisors we work with. Here's an example of their core growth stock basket. Last year, the market was up. Remember, 2022 was the market was down. And so if the market went down 20%, last year the market was up about 22%. Brookstone's growth stock portfolio did 35%. And so it's a little bit different. We're not buying a broad-based index selection. We're not necessarily doing something like that. We're going to go into individual stock positions, but there's not a lot of activity as far as in and out trading. And so that's one approach. We have numbers of kinds of portfolios to choose from, but here's an example. So if you did a 35% return in growth stock, and on top of that, it was diversified among different sectors, that's one way of getting there. But at the same time, we also offer structured note approaches that are a combination of securities and also maybe a bond component, but with a security feature. So maybe a 12-month commitment that's paying a 12% or a 10% return income each month coming into your portfolio, not a T-bill, but you're talking about income coming in, but it has a buffer against it for downside risk, kind of like today. So you would keep on getting that income stream. And then the last item that we use, we have a bond replacement. Anyone that's been around long as I have remembers large drops in the market like 2020 or 2008. When bonds, stocks, real estate, everything dropped at the same time, correlated. So when you're trying to live on a fixed income or a fixed income profile or a pension, you want to make sure that vehicle's not going to be unstable. And so what we saw in 2008 was bonds becoming unstable. So I decided to replace bonds with a short-term 5-year fixed indexed annuity for the right reasons. Number one, a quality credit. When things in 2008 weren't necessarily the credit they said they were, this relieves that. So when you use a short-term, I say short-term 5-year fixed index annuity that has A+ credit, every dollar going into that annuity contract has $1 of reserves. Unlike lots of securities out there, you're not going to see $1 of reserves for every dollar going in. So we use that component as a slice of the pie. We'll talk more about that. That's just the bond component. And so we want to make sure that your bond component is stable. And so with that, in our first meeting, we go through a discovery process. And here's a picture of Joe Rodriguez, for example. He's got $1 million portfolio, and he may be driving, and his risk score is 35. So he's comfortable driving around the curves at 35 miles an hour. Maybe you're driving around the curves at 76 miles an hour. That's quite possible. So we want to find out, what is your risk tolerance? And we do that with something I call financial optometry. We look at these 15 questions or so and go, which one's better, right or left? Which one's better, right or left? And so we get down to your risk score analysis pretty quick. And with that, it gets to the point, and you're fine to identify the risk score that you might have. But that also doesn't necessarily tell us where you are in your portfolio. And so with that, we want to find out what's going on inside your portfolio. And so when we do that second meeting analysis, we break things down and find out, hey, maybe you have way too much money in cash or too much money in stocks compared to what your risk score said. And so if you have to have a reallocation, what does it look like? So I take your analysis score of, let's say, a 35 for Joe, and find out that you're really a 52 and we need to bring you up. Or maybe you're 76 and we need to bring you down to a normal score that you said you were. And if you're going to be able to find a way to we can either lower that risk score or bring you right size where you need to be to get you to the maximum number you want to have to achieve your goals. We want to find a way ultimately to lower your risk score, improve your opportunity for growth and income, and do it at a lower cost. And that's the idea. So with that, those 3 big goals. Now, tonight, we're going to cover 3 reasons why you might need to change your retirement strategy in 2024, why average returns could be costing you money, and also the danger of a market downturn in retirement, kind of like what we may or may not be seeing right now, and also why retirees with guaranteed income are happier and live longer. And so with that, who is this presentation for? Well, this presentation is for people that are looking for a safe way to accumulate money tax-free, number one. Number 2, if you sold a business or you have inherited a business or inherited an IRA account, for example, if you had someone pass and you've inherited a portfolio, this is for you as well. If you have a large asset, in an example, if you have a large asset you're trying to manage, this is for you as well. If you're in retirement or pre-retirement, this is for you as well. If you have a 401k rollover you're talking about, if you're thinking about retiring in the next 3 to 6 months, maybe even a year, this is for you as well. And so all those folks are going to benefit from this. At the end, we're going to offer you a free consultation with myself to walk through your current investments. And I don't need to see statements or anything like that. I just need to do a discovery call with you. We'll walk through a conversation and do our analysis, and then we'll go from there. But we want to find out if we can identify and devise a strategy that's going to best protect you in your income and your growth in retirement. 3 reasons why you might want to change things in your strategy in 2024. So first off, reason number 1, U.S. inflation hit a 40-year high, which we just found out about today again. And so a 40-year high on inflation. So with that, here's that same article that came out today. And the answers are, what happened to inflation today that actually occurred in January? Well, we had an increase in shelter costs. We had an increase in car insurance. I can attest to that. Communication costs, personal care, airlines expenses, education costs, physician health care, as well as hospitals. And so I'll throw in there, personal care might be pharmaceuticals. So how have you felt this? Put in the chat box there if you felt this, or if you see anything else I've left off the list that you can attest to that has been a big change for your budget, just that you've been obviously noticing these things. And so that's the first thing. Then the Fed, because of the inflation issues, the Fed has been deciding, hey, they raised rates literally for the last 3 years from almost 0 quarter point to 5%. T-bills are pulling 5.3% right now. So the Fed raised rates 3 years in a row, and then they put on a pause, and then they said, oh yeah, we're going to cut. They alluded they were going to cut. And then the markets said, well, all these analysts say, well, we think there's going to be 4 cuts, 5 cuts, 6 cuts. When are the cuts? We don't know. It could be March. And then they put the kibosh on March and said, well, now it may be May. And so because of today's inflation numbers, they are probably going to put a pause on a rate cut. What if they flip the script and go a rate increase? And will the rate increase happen short term or long term, or are they going to pause and watch this out and see how it changes things? And so inflation raises everything. Interest rates, what does that do? Well, it certainly raises everything. And so your cost of goods goes up. Everything goes up with inflation and interest rates, right? So then on top of that, reason number 3 is the world's largest hedge fund manager, Ray Dalio, thinks there may be a market correction. I tend to agree. I mean, you had a run up. You've had a run up since 2014. Got to let you know, but we've had a run up since November when everything was gloomy in October. The market ran up in November, solid 6 to 8 weeks. We've had at least a 15% push up. And so when you thought things were terrible, all of a sudden it's been awesome. And there's irrational exuberance, and the market's kind of hitting that what we had in 1999, a blow off top. So we'll see where it goes. But the idea is it could be a pretty big dramatic drop. 1 week ago, I pulled out a weekly chart, and we circled a couple places, and it said basically that this chart right here has got a couple indicators that had a couple sell signals on the weekly chart and a couple indicators. And so where are we today? Well, here's what happened today. We had a drop. I think that's a 3-hour chart, but we did have about a 2% drop in the market today. It could go down. How far could it go? Well, I mean, if you drop down to the 200-day moving average and all the indexes, it's about a 10% drop. You would expect a 10% correction to be fairly healthy, actually, if we've already gone up 15% in a short-term window. So we shall see. We shall see. So we don't know where that's going to go. We'll know more tomorrow, right? And so when you think about averages and average returns, how could that be costing you money? Well, many financial firms brag about their average returns, but let's look at why that could be a deceptive number. The biggest concern is, let's say, as an example, and again, as an example, I'm going to use some easy numbers here. $2 million portfolio. Let's say you have a $2 million portfolio, and you have and I know, rare, let's just say the market goes down, for an example, 50% in 1 year. Now you have $1 million and you are gloomy Gus and your head's in the curve and you're sad. $1 million portfolio, $1 million portfolio. So as an example, now, what if the next year the market goes up 50%? Boom, you're excited, you're exuberant, but your portfolio is at 1.5 million. So now you're up 50%, you're at $1.5 million. What was your average return? Well, negative 50 plus 50 is equal to 0. So your return is an average of 0%. You turned $2 million into $1.5 million. It cost you $500,000, and that was 25% of your principal. So it's a little bit deceiving, and that's why averages are not enough in retirement. You do need guarantees. Now let's talk about guarantees for a second. So Kiplinger did an article about how retirees with guaranteed income are happier and live longer. You know, I have to admit, everyone that I know that I come across, that I talk to, that has a pension or pension income on top of Social Security certainly do feel more confident, more comfortable, less stressed about the ups and downs, politics, all of the things, right? And so they do seem more comfortable. Now, here's another reason why you need guaranteed income. The danger of a market downturn in retirement. Now, I'm not saying that we're going to have a major downturn. I'm saying that we have a correction today, a small correction at that. First time we've had a correction in about 2 weeks, actually. So it's just an up and down. Now, what happens though, and this is called sequence of returns risk. What happens, like a 2001, 2002, 2003, what happens in like a 2007, 2008, 2009 scenario? So on this screen, you'll see two different columns, and some people may be numbers people, some people may not be numbers people. I'll talk about it in green and red. Okay, so on the left-hand side, far left, you have a column that has red at the top. So you had losses the first 3 years in your 40s, and then down all the way in, you got some losses and gains sprinkled in, and then the very bottom, you have gains. And that was a $684,848 ending number at age 65, and it had an 8% average return. On the right-hand side, you started out with gains the first 3 years, sprinkled in with losses, and then losses at the end at age 65, 8% average return, $684,848 at the end. So what's different about these two portfolios? All there is in a difference is they both started out with the same amount of money at the very beginning, $100,000. They both averaged 8% returns across the board. All we did was split the returns on one side and the other. They're identical returns in a different order. So what this is illustrating is the fact that if you don't have a withdrawal coming out and the numbers are the same, it doesn't matter what order they come in. Now, what does matter is if you're taking out withdrawals for income in retirement. So if you do take out, let's say you retire at 66 and you're taking out 5% of your portfolio for an income draw at the beginning of the year, on the left-hand side, you took out 5% plus the market went down 12%. And you took out 21% plus the market went down 5%. Plus the market went down 21%, you took out 5%. Third year, you take out 5%, the market went down 14%. That's a double dip. And so this kind of compounding without any kind of excess or any kind of inflation back into your portfolio, this can have a negative effect dramatically on the timeline of your portfolio. You'll see this portfolio, even though they had gains the 5 years after the first 3, and then a couple sprinkled losses, but even though we had gains immediately after, this portfolio with that drawdown at 5% ran out of money at age 82. You don't want to be in this kind of situation. This is exactly what happened in 2000, 2001, 2002 for a lot of people that I came across that came to me because they were drawing down on their portfolio and the market was dropping at the same time, and they were kind of surprised. And if you had a drawdown or had a loss in that window of time, it might have made, maybe it took you 5 or 6 or 7 years to break even and get back to where you used to be. Now, on the right-hand side, you could have been lucky. You could have been, maybe you retired in the 90s and then you got gains, a little loss, gains, a little loss, gains, a little loss, and you're happy as a clam with $2 million, and maybe you had $3 million. It doesn't really matter, but it's all about the returns that you can't predict in the market and when they come in if you're taking a withdrawal. And so this is why we use a balanced approach and why we want to have a buffer built in for income draw at retirement and not just take it out because it's there. It's important to have a plan like this. And so why we look at this is like $1 million income with a negative 15% return brings you down to $850. But if you're drawing out $55,000 a year as an income draw, you're down to $795. It takes you a 25.8% return expectation just to get back to break even before the next $55,000 drawdown. And so that's really unrealistic to hope for a 25% return when that kind of scenario happens. So you need to have a buffer built in. And so that's why we use a balanced approach. We want to build in a buffer for income for that fluctuating market we know we're going to have, but have a guaranteed portion as well that's going to drive that income when you know you need to have it. And so you have flexibility to be able to do that. So here are two people that didn't let market downturns affect their retirement plans. The first one is Babe Ruth. He had a lot of money in guaranteed income, and that helped him survive the Depression. The second one, Shaquille O'Neal earned $300 million as a professional basketball player. Now he's a commentator. He also bought guaranteed income, even though he didn't need it. He bought guaranteed income to protect that income stream coming in so he could do other things and acquire other assets. And he actually owns part of an insurance company. So it's one of those things where it allows him to get that peace of the mind so you know the income's there. But it's not just about guaranteed income. And one of the strategies I use with my clients allows them to participate in stock market gains with zero losses. And yes, I'm talking about fixed indexed annuities. And I'm talking about that 5-year fixed indexed annuity that has a guarantee against losses, but can participate in gains, stair steps the growth like this, and allows you to take income as well. So it goes up when the markets are going up, and it doesn't go down when the markets are negative. And so that's the whole point. So, but you don't have to give up just everything in one side or everything in the other. I'm not preaching to say, hey, I suggest everything to be in the stock market. I'm certainly not suggesting everything goes into annuities. It needs to be a balanced approach, protection plus profit. And so we use managed growth portfolios. We use protected income with growth and also protected income. And so option number one, well, here's where we start our option to give you a chance to do the setup time on our first appointment and do our discovery call. It's a 30-minute conversation, and we walk through our sequence of what we do for our meeting, and we go through that nitrogen software, the Riskalyze, to find out what your speed limit is on your risk assessment, and we have a general conversation. You don't need to bring anything to the meeting, just numbers and your willingness to walk through the scenario that we use for every meeting. And so with that, it's a personal consultation with us. We show you the math, the reasons, the strategies that are being implemented by intelligent investors that are sick of taxes, lack of control, fear of unnecessary losses. And so we walk through all those things. Now is probably a very good time to lock in your time. If you have the slightest inkling to do this, lock it in now. My calendar fills up very quickly. These are 30-minute calls. And I have a short calendar list only because I have webinars on a regular basis on different topics. And so my calendar does get pretty full. So lock in your time. You'll see a calendar link right there on the pop-up. That's my calendar link. Just click on that. It's going to take you to another screen that's going to show a blue circle. Click on the day that you want to lock in on that appointment. And then it's going to open up and give you a choice of times. Lock in on the time, fill in your name, your phone number, your email, and let's move on and take advantage of it. And we'll sit down and have a Zoom call and walk through some things. And again, no pressure on your part, no cost on your part. It's a zero cost strategy. This is ideal if you're trying to build wealth and protect assets, and you want to get educated on how to sustain your retirement lifestyle at a better picture than you thought you could. And that's what we try to do. We cover our 3 big goals. Number one, doesn't cost a thing. So I take advantage of this right now and do it as we're talking and get ahead of the pack. That's my idea. So next up, we're going to talk about, required minimum distributions in 2024, the RMD. And with that, you might say, hey, Mark, let's talk about RMDs. So 5 questions baby boomers want answers for. How do I calculate my RMD? Okay, number one, how do I gauge the taxes on my RMD? And then can I save any money on taxes? Is that even possible? And then on top of that, what are the rules for beneficiary designations different than your other accounts? And so we'll talk about that as well. And we'll discuss a couple issues like beneficiary IRAs. How do I know if my allocations are appropriate for RMDs? And so With that, here's a picture of the latest tax tables. The tax tables for 2024, you have the highest tax bracket down here at 37%. You might say, man, that's really high. That's really high, 37%, man. It's like, yeah, but I got news for you. Here's the tax tables historically, and that red box, let's look at the red box. 1950 to 1964, we had a range on the highest tax bracket as high as 92% of your income was going to be eaten up by the U.S. government. Love being patriotic, but that's a little too patriotic in my opinion. So 92%. So I do remember a quote by Ronald Reagan when he was an actor, a movie actor. He mentioned that he only did about 2 movies a year during that time frame because he made over $1 million a year. And after that $1 million income level, he was seeing all his income go out the door to taxes. So he just go back to the ranch and start working on horses. So is that a possibility? How many people think that taxes could go up if we're at a 37% tax bracket? And let's see, where was it in the past? Well, see, if you go back to 1932, taxes were 63%. 1947, 86%. 1980, 70%. That's not too far off. 2010, 35%. We've had a really easy time since about 86. They were as high as 50%. Who thinks that since we just spent $7 trillion of federal money on our deficit now, who thinks taxes have the potential to go up? If you believe it's going to go up on taxes, put a 1 in the chat box. If you think it's going to be a flat or 0, put a 0 in the chat box. Give me some ideas here so I can kind of use that for my next meeting. I think there's no doubt we're going to have tax increase, but I want to hear what you think. Okay. So with that, let's talk about required minimum distributions. The government always wants you to save for your retirement, but they also want a piece of the action, right? They want a piece of the action. So one of the things that did change, if you have an IRA, these were designed for an income stream, not necessarily in your benefit, but the government's. The required minimum distributions must be withdrawn, and if you don't do that, you're going to have a 25% tax penalty if you don't take it out either the right amount or the right time. Now, this used to be a 50% penalty, but this has been changed. And so the big changes to RMDs, number 1 was the Secure Act 2.0, which will, in fact, it'll impact the following things. And so, number 1, the RMD penalties decreased to 25% of the amount taken. Now, if you don't take the penalty in the correct time, they may give you a waiver on the penalty. I've seen that happen before, but for the most part, they're going to hit you for 25%. Now, also, Roth IRA accounts are no longer required for 2024 in employer plans. Also, beginning immediately, you can do an in-plan annuity payment that can't exceed the participant's RMD amount. The excess annuity payment can be applied to the following year's RMD. And then here's the big one, if you turn 72 in 2023, you have until December 31st of 2024, or no later than April 1st of 2025 to take your RMD. Now, you got until the end of this year to take your first withdrawal as your required minimum distribution if you just turned 72 last year. But here's the catch. If you don't do it this year and you take it next year, you're going to have to take 2 distributions, one before April 1st and one before December 31st. So just account on extra income tax, and that may or may not affect you in other areas. And so with that, you want to say, well, how do I calculate my RMD? Well, there's a uniform time tax, a lifetime tax table. And it basically amounts to the first year is obviously 73 this year. It used to be 72 and a half. It got very convoluted during COVID. IRS changed the rules and got everybody confused. Now they just made it 73. And so you take this 26.5 distribution period, and I'll show you how to calculate this. And so how we do that is this. Number 1, you take your RMD. It's going to be the balance on that IRA account at the end of the December 31st window. And so they normally will send out a statement to you saying, here's your December 31st value that we use to calculate your RMD for your IRA. And so you take that value times your life expectancy, your LE number, and you divide that by your LE number. So if let's say you have an IRA of $100,000, you divide it by 26.5, And then that's going to give you your required minimum distribution of $3,773.58. So if you have $1 million IRA and you turned 73, add a zero. That's a lot. And that's forced income, by the way. They force you to take it out whether you like it or not. So, and there's no other way to get around that, by the way. There's no rule unless you just move it to a Roth. We'll talk about that in a second. So this is a progressive tax table. It does not get better. And so it's one of those things where you're really going to be forced to do this, and it recalculates every year. So not understanding how RMDs work with 401ks. And so if you're 72 years old and you have $1 million in savings, you might have IRAs, and you can do required minimum distributions out of your IRAs. You can take them out of one IRA or multiple IRAs. You can do a combination. If you have 401ks or 403bs or 457s, you must take each one of those RMDs out of each account separately. There is a firewall between these. You can't commingle the IRAs with the 401ks or the 403bs. These have to be separate on this side. If it's a plan, if it's a regular IRA, you can take it out individually or combination. My recommendation, take them out of every account separately so there's no confusion and you don't get those nasty little letters from the IRS. So that's the way to play it safe. Don't commingle on the other accounts. So here's what needs to be taken separately: 401ks, 457s, 403bs, and here's what you can do combined would be IRAs. Now, what is the taxation and how does it work with RMDs? And so RMDs are taxable at ordinary income, and there is no capital gains tax, okay? So the only exception is if there is any non-deductible after-tax contributions. The withdrawals are prorated, but other than that, next up we're going to talk about Roth IRAs. What is a Roth IRA? Well, it's an individual retirement account. We already know that, but it's also designed to help supplement income. And IRAs are designed for retirement, and if you take out withdrawals before 59.5, there's a penalty, but you can take them out after 59.5. And then you can convert this to a Roth IRA if you choose to. Now, traditionally, IRAs were designed to give you a tax break on your taxes. Ultimately, it's a plan to give income to the government, and it's not really helping you other than creating a tax bomb. The bigger that IRA grows and gets, the bigger that tax bomb builds. And so, what you want to do is find a way, if you can, to convert that to a Roth IRA. And the ultimate rule is here: if you're going to do a Roth conversion, you're going to have to pay tax on that amount that you're converting in the tax year that it happens. And that's the big takeaway. Once you grow that as a Roth and it is growing tax deferred, the income or the assets come out tax free, and you can't avoid that. Now, the only issue here is the income limits on whether you qualify for a Roth IRA conversion or not. And so, if you're married and you have joint income, if you're making less than $218,000 a year, you have the potential of doing a Roth IRA, and you could do that. If you have income as a single person, head household, less than $138,000, you can do a Roth. But if you're over those numbers, you're kind of out of luck, like many of us. And so it's one of those things where if you have the ability to do that, then I would take advantage of getting anything to a tax-free position. Tax-free is always better than any other kind of income, right? I mean, isn't it? So tax-free is the best. Tax-deferred is good. Tax-free is better, okay? So maximizing your Roth IRA and your conversion. So how do we do that? Well, we know here's the tax tables. 37% is still that highest number, but if you take distributions and you're forced to take them by 73, you're creating a taxable income that can also create greater taxation, especially if you do that double dip on that first one and you wait till 2025. That could actually have a ripple effect on your provisional income and actually might affect maybe your income limits on Medicare. And so it's one of those things you want to take a look at those concepts before you do these things or before you wait too long. So a traditional IRA going to a Roth, you simply pay on the transaction year that it happens. You pay tax on the amount of money that you convert to the Roth. And then moving forward, doing this wrong can increase your healthcare costs, like I said, on Medicare. It can increase taxes on your marginal income tax rate, and it could also increase capital gains taxation. Now, if you said, hey, if I do this Roth thing, I can always change my mind and reverse it like it used to be, not so much. They took that rule away. When the Roth first came out in 2010, they gave you a recharacterization option, and that is long gone like the dust. So that is not an option. Now, one of the things that we also do for clients is we have some software tools that, now we don't do tax preparation, we do tax planning. One of the things that we can do is we can take your 1040, we can put it into our software program, and we can create a report that gives you a list of up to 30 different kinds of tax strategies. Some are ideal, some may be far-fetched, some are right on point, some are maybe a stretch, and some maybe take a leg into to get done, but they might be advantageous to you to save thousands of dollars on taxes off the top. And so if it's worth thousands of dollars in tax savings to you, you might take a look at this. We do this for our clients on a regular basis. Would a Roth conversion be good for you? We don't know. How about we run it through our software? I don't think your CPA is probably doing this for you. No, they're not. Just to let you know, they're not. They do tax preparation. They don't do tax strategy necessarily unless you pay them to do that. And so this is what we do for our clients. Now, also, if you are a business owner, let's uncover more tax savings with the same approach. Again, would a tax-free income be a better income? Is there any better kind than tax-free? No, there's not. Tax-free is the best way to go. One thing about business owners, they're usually over the limit on what they can contribute to a lot of tax plans that are out there by the government. And so we want to find alternatives that you can use to give yourself a tax-free income for life. And so we want to find a way to protect your income, protect your legacy, protect your business, and your livelihood. So we also do that same strategy with that same approach. So with that, it's going to give you a way to navigate the next tax hurdle. You come in and let us do that review. We're going to find out, hey, is it optimal up to that red line right there where you're going to have a new tax bracket? What can you do to avoid this? And so we look at that in our strategies. And so we do uncover those things when we do our tax strategy in our software. Now, let's talk about case study samples. And so we're talking again about balanced approach, managed growth, protected income with growth with income, and also protected income. So here's case study number one. And I say our strategies generally will work well for anyone that has $500,000 in investable assets or more. Sometimes less, but mostly $500,000 or more, because we can hit your expectations and then exceed it very, very, pretty much on target. And we'll talk about that. And so here's case study number one, $626,457 in investable assets. Their current investment management fee was 1% per year, or $6,265. When we did our risk analysis and we got the speed limit for them, they were a 51. And so what we came back with was our balanced approach for growth and income. They wanted income at retirement for the rest of their life for over 30 years. And we moved their risk score to a 1, okay? A 51 to a 1. We'll talk about that. We solved for lifetime income and market growth, okay? We reduced their fees by 85%, saving them $5,325. What did this look like? Well, the allocation that they had originally was some stocks and bonds, a lot of money sitting on cash because they were a little nervous, right? Understandable. But also it was allocated with a fee. And so some of that was heavily feed. And we repositioned this and we lowered their risk score dramatically. Okay. And we also lowered their fees dramatically. So how'd that turn out? Well, when we stress test this portfolio, we want to find out, hey, how did this perform in a market like 2013 or 2023? Did your portfolio have a 51 before and now all of a sudden you're a 1, but did you still have the same opportunity for growth? Yeah, we lowered your score and you still have the same upside potential, but no downside. Okay, that's the idea. If you had a 2008 bear market scenario or a 2020 scenario for a short-term window, how would your portfolio respond to that? The market dropped 35% in 2008. Would yours do the same thing? Well, ours would actually go up slightly. Okay, that's an improvement. Now, what about a financial crisis, a full-blown financial crisis for 2 years or more? How would your portfolio be affected by a 50% drop in the market? How would ours do? Ours would actually would benefit. And so also, if you had a rate increase, rate decrease, deflation, inflation, all these things are reflective. And so we want to find out how your stress test is going to come out in your portfolio, the regular market reacted in historical events and how ours would do at the same time. And so that's number one. We want to do a balanced approach. We want to find a way to give and drive income for the rest of their life with flexibility. Okay, that's the idea. So case number two, $1.4 million in investable assets, current management fee, again, 1%, $16,944. And I go back to our fees. Go back to onthemarkmoney.com, go to the sitemap at the very bottom of the page, click on that, look at our investment schedule, our investment advisor fee schedule right there, and you're going to find that we are dramatically less expensive than, I would say, 99% of our competitors. I've done this for a reason. I'm sowing a seed forward. That's the reason. And it's one of those things where you're going to find a immediate savings. We have transparency. We have, Schwab as our custodian. We have billion-dollar asset managers. So it's not like you aren't going to get first class. You are. So we saved this client $13,000 in fees. $13,000 in fees, 77% reduction in fees. They had a 52 score. But here's what's interesting about this. They had a 52 score on their risk assessment, their speed limit. But they were invested mostly in cash and bond funds because of poor prior trading experience by their advisor. Okay, so they were a little gun shy. Their risk score was way under a 52. They were at a 15, actually. So we did something a little bit contrary. We actually raised their risk score, but we also kept their risk score in line with expectations and their growth in income expectation. And we also saved them on fees. And so how'd this turn out? Well, they had, again, a lot of money sitting in cash and bonds, a ton sitting in the wrong asset class. And we repositioned that, and they were being charged for this too. And so it's one of those things. We repositioned this, dropped their fee dramatically, but got them back to where they could comfortably grow in inflation. Think about this. Where are T-bills right now? T-bills are sitting at 5.3% for a 3-month T-bill. Is inflation higher? Yes, it is today. How high is, 2 years ago, checking accounts were pulling what, 2%? Maybe 2%? But inflation is much higher than that. So are you making money in checking and savings? No. Can you make money long-term in a safe short-term vehicle like a T-bill? No, you're not going to beat inflation long-term because the interest rates go like this, right? And so that's the problem with short-term interest rates. They're great for short-term, but it's not a long-term plan. And so unless you tend to keep track of the last thing that ever happened, you want to be your own investment advisor. You want to be your own investment advisor. This is probably not for you. Okay, if you're looking for some kind of little nugget about trading today, this is probably not for you. If you're looking for a solid plan to get you through retirement for the next 30 years, and you want to have someone there to coach you and get you there, then this is for you. Okay, so the idea here is you're going to have something that's going to ride the wave with inflation, with ups and downs and interest rates and inflation and up and down markets, and done appropriately with a buffer. So what we did was we built this out to do all those things: drive the income, drive the buffer, make sure it's there for 30-year window, and also save him, in this case, it was $13,000 in fees, right? And so it's not just about the fees, it's about getting the income and the growth for the rest of your life and knowing your portfolio is still growing this entire time. So we hit goal number one, we hit goal number two. Goal number one, get you to a higher, goal number one is to protect your assets and your income throughout your lifetime, and also lower your fees by at least 40%. We lowered the fees by easily 40%. We protect the income throughout the lifetime, but we also 2x and even 3x this with an income stream. So that's pretty good. Now, goal and case study number 3, I should say, $6.9 million. Come across these also. Current investment fees were 0.6% per year, or $41,440. Okay. Started out with a risk score of 67. Was pretty much in stocks and cash, combination of both. Wanted to drive for a $240,000 income per year. Could have gone higher. Wanted to think about $500,000 a year. Okay. $500,000 a year, which is really kind of pushing the limit because that's 10%, almost 10% draw. But we went with a 5% scenario, 4% scenario there. So we're using a balanced approach again, balanced approach for growth and income. solving for lifetime income plus market growth, got the score down to a 44, okay, reduced fees by 42%, brought their fees down to $24,173, saved $17,266. What's this look like? So risk score 67. So he had a large window there. He could go up and down, but in this case, again, more stocks than anything else, but a lot of cash sitting on the sideline for trading activity. Okay, but in this case, we went a different way. We went with a balanced approach. We had some structured notes, we had some stocks, portfolios. We had a couple different things going on here, and we also had a slice in there that gave us protected income. And at the same time, we decreased the risk score from a 67 down to a 44. We hit the income number, we hit the growth expectation, and we did that all as an inclusive of goal 1, 2, and 3. Number 1, lower the fees by 40%. We did that by 42%. Number 2, protect the income for the lifetime. We did that as well. We don't want ups and downs taking us out. And number 3, we want to make sure we can do a 2x or a 3x on the portfolio, and we did that as well. So there's 3 case studies that are a good example of how we can go, average to upper average. And so with that, here's your option number 2 to sit down with me, and let's take a look at that one more time. Here's the offer. So do this, sign up today. I recommend that you sign up today. It's painless. Number 1, there's no fee to you. It's going to be a complementary strategy. Sit down and take a look at the math that affects you individually, the reasons why we're trying to hit for your goals and what concerns you have. Also, the 3 goals that we try to implement all the time. Try to find a way to lower taxes, get rid of unnecessary losses and right risk your portfolio, and then drive for an income. And so those 3 big goals: lower the fees, protect the income, and then try to find a way to right size your portfolio in the right risk, and also 2x or 3x it over a window of time. So with that, this again is for people that want to build wealth, protect and protect your assets, and do it and have a sustained, comfortable lifetime in retirement, not a get by lifetime in retirement. You don't want to sit there and stretch. You want to be able to do this comfortably. And so if you want to take out $20,000 a month, $30,000 a month, and you have a large asset base, we can find a way to make that work. We're going to find to make it work at the right risk. And so how do you protect your retirement income throughout your lifetime? That's important. And so with that, click on the button, take us up on this offer. I'm going to let that sit there for a second. I think that is the last screen we have. It's worth 30 minutes of your time. What's the risk? 0. No risk. There's no risk here other than time, your time and my time. The difference maker could be tens of thousands of dollars. Our biggest savings I've come across in the last 33 years, I saved one client $110,000 in taxes. $110,000 in taxes. That's my biggest win so far. Lots of little wins at $5, $10, $15, $20, $25, $35,000 in fees and taxes in combination. But $110,000, maybe I can beat that with the next big case. I don't know. This was actually not a very big case. It was just a lot of combinations of things that it just all started stacking, and I was like, "Wow, this is amazing." So, how can I do that for you? I don't know. Let's lock in a time right now and find out. When you go and click on that calendar link right there, and you're going to see my face there, and you're going to see the calendar. Click on the blue circle. On the blue circle, pick a time. On the time, click that time, hit next, put in your name, your phone number, and your email, and lock in. And make sure you do it quickly because it will fill up. It will fill up. There's the blue dots. And so with that, we want to find out more about what your concerns are. We walk through our same process every single time. Our first meeting, no cost, no obligation. At the end of our first meeting, you'll decide, hey, do I want to move forward with this? Do I want to find out more? And what we do is we take out, information. We plug in your portfolio. How's that look? Well, we don't necessarily need statements. I don't care if you give it to us on legal pad. We give you a secure link that you can upload things if you want to. You want to upload statements to us and information to us. That's great. It certainly works faster, but I don't need that. I've taken it over the phone and typed it in myself. Our software is that sophisticated. It's going to find what kind of investment you have. You know the name. If you say, hey, I've got a Vanguard portfolio and it's or I've got a total return bond portfolio, or I've got the Admiral Fund, or whatever the case may be, if you have Fidelity, this, it doesn't matter. You name that portfolio item and the amount that it's in that portfolio, I can put that in and plug it in, and we can build this out if we have to. But ideally, bring us some statements, upload it. I black out the personal information. I don't need to see anything like that. That's not necessary. I just need to have data. So that's what we do on our second meeting. On the first meeting, we simply have a conversation. So with that, lock in on the appointment there. And then any questions in the question box, any questions you want to put in, pop that in there. Let's see if you have anything there that you'd like to see. I'd be happy to answer for you if you want to. And with that, I'll put that offer back up on the screen. The idea here is lock in. I'm going to have meetings weekly on different topics, but tonight's is Roth and RMDs and investments, of course. Always similar things, but we have some things moving in the markets. Don't know where that's going to take us tomorrow. I got a feeling, though. I got a feeling we're going to have probably a little run up in the morning and then a reversal in the afternoon, kind of like what things have been doing in backwards mode. So you could expect that because we had a pretty hot last 6 weeks or so. So I would expect things to make some changes here. And maybe that is going to affect you individually, and you want to take a look at that. So how does that affect you? Let's talk about your personal situation. And so with that, again, it's a $497 value when we go through our second meeting. Our first meeting is free to you, free to me, my time, but I mean free your time as well. But the idea is there's no cost to do our analysis. We walk through our simple software that gives us a quick assessment on risk tolerance, your speed limit, and maybe you're different than your spouse, your partner. Both would be on the call. That's fine. We want to find out, where this is for you individually and what your goals are. And so we do that assessment as a first meeting. Generally, we have 4 meetings with a client. If we go through meeting number 1, you're going to decide if you want to go through meeting number 2 and take it another step. Again, if you go to meeting number 2, the cost for us is $8, and that's a $1 for our second meeting, and I donate that at the end of the month. That's not why we do it, because we want to make you a client and we're a fiduciary. So we're by law going to work for your best interest first, and that's the rule. So we do that with a very low bar, $1. So on the first meeting, though, zero cost to you. We do the assessment, and then we do that full-blown assessment on the second meeting. And so with that, take advantage of that tonight. Any questions through the chat box? I don't see anything right there. But I do appreciate your time. What I'm going to do now is I'm going to sit this here, and I'm going to close this out. What it's going to take you to, again, is the calendar link, and you're going to see that calendar link. Take advantage of the times tonight. Pop in and lock in on that calendar slot, and then it'll give you a confirmation email, and then we will also set up a call and respond back to you that we've gotten that and confirm it, and then we will soon talk. And so with that, I want to thank you guys for showing up tonight, and we hope you enjoyed it. And if you have any questions in the Q&A, I'll sit here for a few seconds, and then I'll hang out and wait for those to pop in if you have any questions. Okay, I don't see anything coming in on the question side, so hopefully we will see you soon. Take advantage of it, and I'm going to close this out. It'll take you right to our calendar link here in a few seconds, so look for that. Lock in on that free meeting, and then we will see you then. Thanks so much.